Hi guys, and welcome back to Insideinvesting, and today we're discussing what's an ETF. Because in the last couple of videos we've discussed a few specific ETFs, such as the S&P 500 ETF from Vanguard, as well as the Vanguard All World ETF. So in this video we're gonna discuss the pros and cons of ETFs and why we like them so much. So grab a cup of coffee, relax and listen up. Let's go. So in this video we're discussing with you what's an ETF. And an ETF actually stands for an exchange traded fund. That means that you can buy, hold and sell this fund via an exchange, and it tracks an index, commodity or bond. So an example, the last video where we discussed the S&P 500 ETF that tracks the S&P 500 index. An ETF is traded just like stocks, so similar to, let's say, you buying a Tesla stock or a Facebook stock. You can also just buy an ETF and hold one or multiple shares of a specific ETF. So what's then actually the purpose of an ETF? And that's actually the same securities, same proportions as a certain stock market index actually. And it's designed to keep trading close to its net SO value, which we also discussed in the last few videos. The most popular ETFs replicate the S&P 500 index. How does an ETF then actually look like? Well, in this case, the S&P 500 ETF includes multiple big companies such as Apple, Tesla, Facebook, Amazon and Microsoft. So from these companies you can actually buy shares as well. So you can buy one share of Apple or one share of Amazon, for example. But if you don't want to buy them separately, you can buy an ETF. And that ETF then includes multiple companies. And in this case, for an S&P 500 ETF from Vanguard, for example, it then includes a lot of different big companies. So all of these companies combined make up the eventual S&P 500. And in this case, there are a lot of more different companies included, but these are just a few big companies included in this exchange traded fund known as the S&P 500. So let's have a look at how this S&P 500 index is actually performing. In here we see the graph that started quite some time ago, around 1981, and we see that over the years it has grown significantly. So if you would have invested in the S&P 500 index, let's say back in 2001 or 2011, you can still see that you could double or triple the amount of money that you invest. And that's just the consistent growth that you will see in these big ETFs that include a lot of different companies. Most of the companies included in such an exchange traded fund grow over the year, and you'll see that back into the result and the profit that you're actually making from investing in such an ETF. And this is why we like it so much. If you do want to invest in the S&P 500, look at our previous videos from the Vanguard S&P 500 ETF, known under the ticker VUSA. We'll link that video down below. If we then look at the details of this specific Vanguard S&P 500 ETF, you can find online the different companies that are included in this specific tracker. So in this case we looked it up via the Vanguard website, and you can find very easily for the ETF that you're looking at the companies and which percentage of the fund they are included. So in this case you can see that Apple is one of the biggest funds included, but also Microsoft and Amazon are quite significantly. Overall, what we like a lot about these ETFs is that they include a lot of different companies, and as such percentage of these companies are fairly limited. So if Apple increases significantly or decreases significantly in value, because they're only included for 6.5% in the ETF, you'd see the price drop of the overall value of this ETF be very limited because of only the small percentage that they're included in. But in this case, Apple is the biggest holding, so a stock decrease of Apple would have a little bit more of an impact, but for the rest of the companies, the impact should be very limited on the overall value of your ETF shares, which is very nice. If you also want to start investing, please use the link down in the description to start off your broker account at DEGIRO. We've also made a few videos on how to set up your account. You can find those videos back up on our channel. So please subscribe if you haven't done so already. So how do we then suggest to start investing? Well, we definitely like to use dollar cost averaging, which actually means that on a set frequency, let's say every month, you buy a few shares of, in this case, your S&P 500 ETF. Because you're doing that on a consistent basis, so every month you're buying, you're averaging the costs of the share price. So if it goes down in value, you buy it for a little bit less price. If it then goes back up in price, your buy-in is a little bit more expensive, But overall, this will average out and give you a nice steady dollar cost price of the shares that you eventually hold. This will also ensure that you're not paying in a peak, let's say, and then afterwards it directly crashes. No, because you're averaging in a prolonged period. So let's say in the course of 10 or 20 years, every month you're buying into the stock market. So that doesn't mean that you're buying a lot of shares when the price is at its highest point, because you're averaging over a longer period. That means that you have a nice consistent value of your portfolio. You also, on the other hand, don't buy fully in the dips, because it's actually impossible to predict the market. So you can't ensure that you're always buying when the price is at its lowest point, ensuring that you're investing in a nice consistent basis.
Thanks for watching the video. If you want to learn investing, subscribe to get more free investing and finance tips and tricks. We give you easy to follow, straightforward suggestions on how to start investing and improving your portfolio. Like the video if you learned something new today, and comment down below the topics for the next video.
Then let's have a look at compound interest. So let's say what I mentioned before, you're investing $100 each month over a period of 30 years with a 7% interest rate. That's going to result in approximately $113,000, which is, let's be honest, a lot of money. In this case, you would see that your total contribution would stay exactly the same, $100 each month. But because of the interest rate that you're getting on the increased value of your portfolio, you would see that the value of your overall portfolio is increasing significantly in comparison with your total contribution. And of course, this is in a long period, right? This is in a 30-year period. And that's exactly why we suggest to start investing as soon as possible. And although we do like investing in ETFs, there are also a few cons on investing in ETFs. So it's possible to miss out on return of investment. Let's say you invested in Tesla stocks 10 years ago. That would mean that you had a huge return on your investment because of the significant growth of the stocks. And that goes for more specific stocks that are included in these ETFs, like the companies that we mentioned earlier, such as Facebook, Amazon, or Google. So there is a possibility of missing out on the return of investment. And then looking at the next con of ETFs, which is the transaction costs. Of course, there's some transaction costs included for buying and selling your ETFs, and that's definitely a con from our end. However, and that's what we like about ETFs, these transaction costs are usually quite limited. So they're not that significant in comparison with the possible profits that you can make. So these are the cons, and then let's have a look at the pros of ETFs, because those are for us way more important in this case. So there's no emotional factor included. Because you're buying in a lot of different companies, it doesn't matter that much whatever happens to the specific companies, because they're only included at a small percentage of the overall stock. There are hundreds of different companies, sometimes even 1,000 different companies included in such an ETF, which means that if something happens to one specific company, that doesn't matter too much to the overall value of the ETFs in this case. So there's no emotional factors as such. And this then boils down to the reduced impact of price fluctuations of these specific stocks, which also helps out the emotional factors, right? If you open your broker account and you see that the value of your portfolio didn't decrease by, let's say, a few €1,000, that gives you also some possibility to sleep better at night, knowing that the value of your portfolio is gonna be a little bit more stable. So this is one of the things we really like about ETFs. Also, the costs are lower per share, and this eventually increases the profit that you're making per share, which of course is what we all want, right? We want to invest and we want to see companies grow, and we want to see our portfolio grow together with the companies that are included in our portfolio. ETFs then also help you build a position over time. If you invest on a monthly basis, in this case, you are able to build a position over time, which is of course very important, to have a nice, well-rounded portfolio of a lot of different companies that is very stable and actually very steady over time. And then one of the last pros that at least we think of is that it limits the research time on a daily basis. So let's say you bought into one specific stock. So you bought shares of one company. Then you probably want to know what's happening with the company. What profits are they making? Are they gonna open new factories? Are they hiring new employees? Or are they not doing that? Are they, for example, firing employees? Or are their current profits and their sales targets running down because of, let's say, crisis that's currently happening? This will then cause you a lot of stress because you on a daily basis need to read the newspaper and read the company's financial statements, etc. And for 1 or 2 days, that's of course fine, because that's also what you need to do if you're gonna buy into an ETF with quite some money over time. But if you're doing that on a daily basis for a lot of different companies that you have included in your portfolio, that's gonna cost you a lot of time. And time equals money, so if you can limit the amount of time that you need to invest into your portfolio, into having a well-balanced portfolio, that's way better than investing on a daily basis, needing to research things about the shares that you have. So we therefore want to limit the amount of time that we need to do our research, and that's way easier to do that with an ETF that includes hundreds of different companies instead of very specific companies that you want to buy into. So an ETF actually limits the amount of research time that you need to spend on a daily basis. And that's the last pro that we can think of. And if you now also want to start investing in a specific ETF like the S&P 500 from Vanguard or the Vanguard All World ETF, please use our link down in the description to start your DEGIRO broker account today. So guys, thanks for watching. We appreciate you tuning into this episode of Inside Investing. Please subscribe if you haven't done so already, like the video and comment down below any topics that you want us to cover in the next video. We appreciate you sticking to the end of this video. In the upcoming weeks we are actually gonna buy our first ETF, and you're gonna see a whole video around us buying that first stock. So please subscribe if you want to stay tuned and see our portfolio grow in the upcoming few weeks, months and years to come. Thanks for watching and see you in the next one. Let's go.